Silver reaching the $91 level and gold moving above $5,000 did not unfold as a gradual reassessment. It unfolded as a repricing event. Nearly $6 trillion in global market value adjusted in less than 48 hours, without a single, unifying explanation capable of carrying the weight of that move. That alone should command attention. Large repricing events do not occur because markets suddenly become optimistic. They occur when existing assumptions stop holding, and participants are forced to recalibrate exposure under time pressure. In this case, price moved first. Interpretation followed later, and unevenly. For professionals and researchers, this sequence matters more than the magnitude of the move itself. Markets that move faster than their narratives are not reacting to new information. They are responding to constraints that were already present but poorly priced. The speed of the adjustment tells us something important. When silver and gold reprice simultaneously and at scale, it suggests that the move is not confined to a single asset class or investor cohort. It indicates a broader reassessment of liquidity, collateral confidence, and risk transfer mechanisms operating beneath the surface. This was not a retail surge. Retail flows do not reprice trillions of dollars across correlated markets in 2 trading sessions. Nor was it a simple inflation trade. Inflation expectations did not shift materially enough to justify the timing or velocity. What changed was positioning tolerance. Markets had been operating under a familiar framework: deep liquidity, reliable hedging channels, and stable access to physical settlement when required. That framework allowed large paper exposures to persist with minimal friction. As long as those assumptions held, prices could remain contained. The repricing suggests those assumptions were tested and briefly failed. When tolerance for imbalance disappears, markets do not negotiate, they adjust. Participants reduce exposure, re-hedge, or seek assets perceived to sit outside the most stressed parts of the system. Precious metals, particularly silver and gold, occupy a unique position in that process. They are financial instruments, but they are also physical assets with settlement realities that cannot be expanded on demand. This dual role makes them sensitive to moments when confidence in abstraction weakens. The $6 trillion repricing did not announce a crisis. It revealed uncertainty about whether the system could continue operating under the same leverage, liquidity, and access assumptions that had defined the prior regime. Importantly, the market has not yet agreed on what this repricing means. Analysts have offered explanations after the fact, but none have achieved consensus. That lack of agreement is itself a signal. When interpretation lags price at this scale, it suggests that the adjustment is structural rather than thematic. This chapter is not about predicting continuation or reversal. It is about recognizing when a market move represents a shift in how risk is being evaluated rather than a temporary deviation from trend. In the chapters that follow, we will examine what pressures likely forced this repricing, why precious metals were central to it, and what the market may still be underestimating about the environment that produced it. Because when markets reprice before they explain themselves, the most dangerous response is to assume nothing fundamental has changed. When markets reprice under pressure, they do not move randomly. Stress travels along the paths where assumptions are thinnest and where confidence is most conditional. In this episode, that path ran directly through precious metals. Silver and gold absorbed the shock first, not because they were suddenly rediscovered, but because they sit at the intersection of liquidity, collateral confidence, and physical constraint. They are among the few assets that are both widely used in financial abstraction and anchored to non-expandable physical reality. That combination matters when tolerance for imbalance narrows. In recent years, precious metals pricing has been dominated by paper markets. Futures, options, and synthetic exposure allowed price discovery to occur at scale without requiring immediate engagement with physical settlement. This structure kept volatility contained even as macro risks accumulated. As long as participants trusted that physical access remained optional rather than necessary, paper pricing could lead without resistance. The repricing towards silver at $91 and gold above $5,000 suggests that this confidence became conditional. When leverage is high and liquidity assumptions are widely shared, markets appear stable until they are not. The transition is rarely triggered by a single headline. It occurs when enough participants independently conclude that the margin for error has narrowed. Once that conclusion spreads, even quietly, behavior changes. In such moments, assets that combine liquidity with credibility attract flows first. Precious metals fit that profile. They are deeply integrated into the financial system, yet they are not liabilities of any single institution. When uncertainty rises about the durability of hedging channels or collateral chains, they function as a neutral reference point. This does not imply panic. It implies recalibration. What made this repricing notable is not that silver and gold rose, but that they did so together and at speed. Joint movement at that scale points away from idiosyncratic demand and towards systemic adjustment. Participants were not expressing a view about one metal. They were responding to a shared constraint. Another factor amplifying the move is the asymmetry between paper exposure and physical availability, particularly in silver. The paper market allows for large nominal positions relative to the physical base. Under normal conditions, that asymmetry is manageable. Under tightening confidence, it becomes destabilizing. As tolerance declines, the market does not need a shortage to reprice. It only needs uncertainty about who will be willing to intermediate when needed. Liquidity that is theoretically available but conditionally provided is not equivalent to liquidity that can be relied upon without question. This is where metals differ from many financial assets. There is no mechanism to instantly expand supply in response to demand. Mining cannot accelerate in days. Inventories cannot be replenished on demand. Once confidence in seamless access weakens, prices adjust to reflect that friction. Gold, with its deeper liquidity and broader institutional role, moved as a stabilizing reference. Silver, with its tighter physical base and industrial exposure, moved as a stress amplifier. Together, they formed a signal rather than a trade. Importantly, this does not mean that precious metals are insulated from reversal. Markets can restore confidence, liquidity can re-enter, but the sequence matters. When metals move first, they are often responding to changes in the conditions under which other assets are priced, not to changes in their own fundamentals alone. For professionals and researchers, this distinction is critical. The move towards silver at $91 and gold above $5,000 should be read less as an endorsement of metals and more as a comment on the environment that made them the preferred conduit for adjustment. This chapter helps explain why precious metals were the shock absorbers. The next question is, what happens after that absorption occurs, and how the repricing begins to influence behavior across the broader market structure. That requires examining how liquidity, collateral, and access dynamics respond once a rapid adjustment has already taken place. Once a repricing of this scale occurs, the market's focus shifts from reaction to assessment. The immediate question becomes whether liquidity conditions can normalize under the new price regime, or whether the repricing exposed a more durable constraint. Liquidity is often described as depth or volume, but in practice it is a function of confidence. Participants provide liquidity when they believe positions can be adjusted, hedged, or exited without destabilizing the system. When that belief weakens, liquidity does not vanish. It becomes selective. The repricing that carried silver toward $91 and gold above $5,000 revealed this selectivity. Markets continued to trade, but the terms under which liquidity was offered changed. Spreads widened in specific windows. Size sensitivity increased. Certain channels absorbed flow easily, while others required caution. These are not signs of dysfunction. They are signs of reassessment. Collateral dynamics play a central role in this phase. In modern markets, collateral is not static. Its perceived quality, availability, and reusability determine how much leverage the system can support. When repricing occurs rapidly, it often reflects a reassessment of collateral value rather than a change in end demand. Precious metals are relevant here because they sit on both sides of the collateral equation. They can be pledged within financial systems, but they also exist outside them as physical assets. When confidence in more abstract collateral weakens, assets with physical settlement characteristics gain relative importance. This does not imply that metals are replacing traditional collateral. It implies that participants are recalibrating how much they are willing to rely on assumptions of seamless reuse and rehypothecation. Even small adjustments in that calculus can produce outsized price effects when leverage is high. Silver's structure makes it particularly sensitive to these dynamics. Its physical market is smaller, its industrial demand is persistent, and its paper exposure is extensive. When collateral assumptions are tested, silver does not have the same buffers as larger, more liquid assets. Price must do more of the work. The key point is that this repricing was not just about demand seeking safety. It was about the system evaluating the cost of its own assumptions. How much leverage can be carried? How much abstraction is tolerable? How dependent is the market on the continuous availability of liquidity under all conditions? These questions rarely surface during calm periods. They surface during transitions. Importantly, the market does not answer them immediately. It experiments. Participants adjust exposure incrementally. They observe how the system responds. They watch whether liquidity returns unconditionally or remains conditional. This experimentation phase often produces mixed signals. Prices may consolidate, volatility may compress, narratives may regain confidence, but the underlying recalibration continues. For professionals and researchers, the danger lies in interpreting stabilization as resolution. Stability after repricing does not mean the system has absorbed the shock fully. It means it is testing whether the new equilibrium can hold. The behavior of silver and gold following the initial move suggests that the market is still in this testing phase. There has been no rush to reverse the repricing, but neither has there been unchecked acceleration. That balance reflects uncertainty about where the new constraints lie. To understand where this process leads, we need to examine how prolonged conditional liquidity influences market structure over time, and why its effects often surface later rather than during the initial adjustment. As the market moves beyond the initial repricing, the most important shift is not in price levels, but in expectations about how liquidity will behave going forward. This is the phase where conditional liquidity risks becoming normalized, and that has long-term implications. Before the repricing, liquidity was assumed. Participants structured exposure around the belief that hedging channels would remain open, that counterparties would intermediate without hesitation, and that physical settlement would remain optional rather than necessary. Those assumptions allowed leverage to persist comfortably. After the repricing, liquidity is no longer assumed. It is evaluated. This evaluation changes behavior even if prices appear stable. Market participants become more attentive to timing. They break trades into smaller increments. They demand clearer confirmation before increasing exposure. Risk management becomes proactive rather than reactive. None of this signals panic. It signals recalibration. In this environment, the cost of being wrong increases, not because volatility is extreme, but because the margin for error is thinner. When liquidity is conditional, mistakes are harder to correct quickly. This forces participants to prioritize alignment over conviction. Silver's role in this phase is revealing. Because its physical market is less elastic and its paper exposure more leveraged, it tends to reflect these adjustments earlier than many other assets. Price becomes the mechanism through which uncertainty is absorbed. This is why silver's behavior after the initial move matters more than the move itself. The absence of immediate retracement suggests that participants are not fully comfortable reverting to prior assumptions. At the same time, the absence of runaway acceleration suggests that the system is still functional. This balance, functional but constrained, is characteristic of markets operating under revised expectations. Another important feature of this phase is narrative fatigue. As repricing events accumulate, familiar explanations lose their explanatory power. Analysts repeat themes that no longer fully account for behavior. Participants listen, but they act based on structure rather than story. When structure dominates, markets become less predictable in conventional terms, not because they are chaotic, but because traditional signals lose clarity. Cross-asset correlations shift, lead-lag relationships change, models calibrated to prior regimes struggle. This is often when observers conclude that the market feels different. That intuition is usually correct, even if the reasons are not yet clear. For professionals and researchers, this is a critical window. It is the period when assumptions are renegotiated quietly. Once new norms are established, behavior hardens around them. Opportunities to observe transition are lost. The repricing that carried silver toward $91 and gold above $5,000 forced the market into this transitional space. The system has not resolved whether conditional liquidity is temporary or structural. Until it does, behavior will remain cautious, selective, and sensitive to marginal signals. Understanding this helps explain why subsequent developments may produce outsized reactions, even if they appear minor in isolation. The system is operating closer to its tolerance limits. To conclude this analysis, we need to examine what ultimately determines whether this repricing becomes a historical footnote or the foundation of a new market regime, and what silver's position tells us about that outcome. The final implication of a move like this is not directional, it is structural. Markets can accommodate almost any price level if the framework supporting it remains intact. What they struggle to accommodate is uncertainty about whether that framework can still be relied upon. This is the question the recent repricing has placed in front of the market. Silver at $91 and gold above $5,000 did not force an immediate conclusion. They forced an evaluation. Participants were compelled to reassess how much leverage the system can safely carry, how dependable liquidity truly is under stress, and how much abstraction can persist before physical realities reassert influence. These are not questions that receive quick answers. Markets respond to them through behavior, not declarations. Exposure is adjusted, time horizons shorten, optionality is valued more highly than conviction. The system remains orderly, but it becomes more discriminating. This is why the most important signal is not what happened during the repricing, but what has happened since. The absence of a full reversal suggests that prior assumptions have not been fully restored. The absence of disorder suggests that the system remains functional. Together, these observations point to adaptation rather than resolution. For professionals, academics, and researchers, this distinction is critical. Adaptation implies that the market has learned something about its own limits. That learning shapes future responses. It lowers tolerance for imbalance. It increases sensitivity to marginal stress. It changes how quickly assumptions are revisited. Silver's role in this process is not symbolic. It is practical. Its structure leaves less room for error. Its physical base is slower to respond. Its paper exposure magnifies confidence shifts. When silver reprices in this manner, it is often because the system is quietly renegotiating how much strain it is willing to carry. This does not mean the outcome is predetermined. Markets can rebuild confidence, liquidity can broaden, assumptions can be reinforced. But rebuilding takes time, and it requires repeated confirmation that stress can be absorbed without friction. Until that confirmation is earned, behavior remains cautious. That caution is what many observers misinterpret. It is mistaken for indecision, speculation, or irrationality. In reality, it is risk management under revised constraints. The market is not confused, it is recalibrating. The deeper shift exposed by the $6 trillion repricing is not about metals outperforming other assets. It is about the system questioning how resilient its own mechanisms are under compression. Precious metals simply provided the clearest reflection of that questioning. Whether this episode is remembered as an inflection point or a volatile adjustment will depend on what happens next. Not in price, but in confidence. If liquidity becomes unconditional again, the repricing will fade into history. If conditionality persists, it will be seen as an early signal of a changing regime. For now, the market has chosen neither outcome definitively, and that unresolved state is itself the message. If this framework has helped clarify why the recent move mattered beyond headlines and price targets, consider sharing it with others who approach markets through structure rather than sentiment. And if you are observing similar recalibrations elsewhere, in credit, currencies, or commodities, add your perspective in the comments. These shifts rarely occur in isolation. Markets do not announce when assumptions change. They reveal it through behavior. This repricing was not a conclusion, it was a question.